-44%. Wow. That's the year-to-date stock decline for what was, until very recently, one of the most reliable companies on the market, UnitedHealth Group. We're talking about a true titan of industry that's seemingly been brought to its knees in just a few months. So, you gotta ask, right? How in the world does a market darling this big, this successful, just collapse so suddenly? The question seems simple, but believe me, the answer is anything but. All right, so let's get into it. We're talking about UnitedHealth Group. You'll see its ticker is UNH. And really, to get why this fall is so shocking, you first have to understand just how high this company was flying.
And look, to put this in perspective, this isn't just some big company. It's basically a pillar of the entire U.S. healthcare system. We're talking over $370 billion in revenue. That's huge, bigger than the economy of some countries. It serves over 150 million people. So yeah, when UNH sneezes, the whole market catches a cold.
You know, for decades, UnitedHealth wasn't just massive. It was also seen as incredibly smart. Its success was really built on this powerful two-part formula that Wall Street, well, they just couldn't get enough of it.
So let's break that down. The best way to think about it is like a fortress and a rocket ship. Seriously. On one side, you've got UnitedHealthcare, the insurance business. That's the fortress. It's this huge, stable foundation just cranking out steady cash from millions of members. And then you've got Optum. That was the rocket ship. All the high-growth stuff, health services, tech, you name it, all designed to shoot for the moon with innovation and much higher profits.
And this is where you really see the genius of the whole setup. Even though the insurance fortress was the big revenue driver, that Optum rocket was so incredibly profitable that it brought in about half of the company's total operating earnings. It was this perfectly balanced, beautiful profit engine.
So what were the results? Oh, they were spectacular. For years, you could just bank on this thing delivering durable double-digit growth. It was leading the entire industry in profitability. Think about this. Its return on equity, which is just a fancy way of saying how well it makes money with its capital, was a crazy high 27% in 2023. I mean, this was the absolute definition of a rock-solid blue-chip stock.
But then, 2025 happened. And that whole beautiful story just shattered. The winning formula that worked for decades, suddenly it didn't. And that kicked off a massive crisis of confidence on Wall Street.
Okay, so where did it all go wrong? It really boils down to one key number, the medical care ratio, or MCR. All that means is for every dollar they take in from premiums, how much do they have to spend on actual health care? For years, UNH was great at managing this, keeping it around 83%. But then, bam, in the second quarter of 2025, it spiked to almost 90%. Now, that might not sound like a huge jump, but for a company this size, that little change meant billions, with a B in unexpected costs that just hammered their profits.
And things unraveled so fast. It all started with that one number. First, they missed their earnings and profits fall by 19%. Okay, bad. Then, just a few weeks later, the CEO is out. Oof, and then comes the knockout punch. They cut their profit forecast for the whole year by almost 50%. In just one quarter, the whole story flipped from reliable superstar to, well, total chaos.
And if you thought it couldn't get any worse, it did. On top of all the cost problems, there was this other huge dark cloud hanging over them. A U.S. Department of Justice probe into how they were billing Medicare. You know, that's the kind of regulatory risk and uncertainty that investors absolutely hate. It was like pouring gasoline on an already raging fire. So, that brings us to the million-dollar question today, right? If you're an investor looking at this beaten-down stock, is this a massive opportunity to buy a great company on sale, or is it a classic value trap?
All right, let's look at the debate. On one side, you've got the bulls, the optimists. They're saying, hey, look at their incredible scale. Look at that Optum growth engine. This company has been through storms before and always comes out stronger. And now, the stock is cheap. But then you have the bears, and they're pointing to some really big risks. What if these crazy high medical costs aren't going away? What if the government crackdown gets even tougher? And, you know, can you really trust the leadership team after a screw-up this big? So where does our source material land on all this? The final verdict is cautiously positive. Basically, the thinking is that the company's fundamental strengths are still there. But, and this is a big but, the risks right now are no joke. This is definitely an investment for someone who has patience and isn't afraid of a little, or maybe a lot, of volatility.
And look, the key takeaway here is that any recovery is not going to happen overnight. There's a pretty clear three-step path that everyone is going to be watching. Step 1, get those costs under control. Period. Step 2, they've got to clear up that legal mess with the DOJ to bring back confidence. And finally, Step 3, by 2026, they have to prove to everyone that their fortress and rocket model isn't broken and can actually start growing profits again.
So, that leaves us with the big final question. UnitedHealth Group has this incredible history of being resilient, of navigating tough times and coming out even stronger. But let's be real, this mix of problems, operational, financial, and regulatory, this is probably the biggest test the company has ever faced. And whether that famous resilience will be enough to pull them through, well, that's a story that's still unfolding.